We spend a lot of time focused on the daily ups and downs of the market. But what if I told you there are three much bigger forces quietly running the show? Today, we're going to pull back the curtain on the invisible architecture of our financial world.
This quote, it really gets to the heart of it, doesn't it? We get so distracted by the noise, the stock tickers, the headlines, but the real story, the one that truly impacts our financial lives, is being written by these three fundamental pillars.
So, to really get a handle on this, we're going to follow what you might call a chain of causality. It's a simple flow, really. First, we'll look at how credit actually creates the entire system. Then, we'll see how insurance has to step in to manage all the risk that credit creates. And finally, we'll connect it all with interest rates, the tool that regulates the whole thing.
Okay, so let's start at the beginning, credit. And I want you to think much, much bigger than just your credit card. We're talking about the absolute bedrock of the modern economy.
Think of it like the economy's operating system. It's what allows for all the transactions, the huge investments, the growth, things that would be totally impossible if we were just trading physical cash. Credit is what lets us pull future potential into the present. And who uses this system? Well, pretty much everyone. Governments are borrowing to build roads and schools. Businesses are borrowing to invent new things and hire people. And of course, households are borrowing for those big life purchases, like a home or a car. It is a completely universal activity. And that leads to the critical point here. When it gets harder or more expensive for any of those groups to borrow, when credit tightens, the whole economic engine just slows down. Spending dries up, growth stalls. And this is precisely why what's happening with insurance costs right now is so important. Which brings us perfectly to our second pillar, insurance. See, once you have a system built on credit, which is really just a series of promises to pay in the future, you absolutely need a way to manage the risk that some of those promises might be broken. That's the job of insurance. It prices and absorbs the shocks in the system. And if you've been feeling this in your own wallet, well, you're not alone. We're seeing this clear, undeniable trend across major economies, the US, the UK, Canada. Premiums for the essentials, right? Car insurance, home insurance, health insurance, they're all steadily climbing. And believe me, that's no accident. It's a signal. So why is this happening? Look, insurance pricing isn't just pulled out of thin air. It's a direct reflection of risk. Insurers are paying out more in claims. Inflation is making it way more expensive to fix a car or cover a medical bill. We're seeing more climate-related disasters. And get this, it's even getting more expensive for the insurance companies to buy their own insurance, which is a thing called reinsurance. And this is why it matters so much. For almost all of us, insurance is not a luxury. It's a mandatory cost of living. You need it to drive a car, to own a home. So when those premiums go up, it's a direct hit to household budgets, which leaves less money for everything else. All right, now for the final piece that ties this whole story together, interest rates. Think of rates as the master lever, the great connector that links the world of credit with the world of insurance. This statement right here is really the anchor for our whole conversation. When you hear about the Fed or another central bank making a decision on rates, it's not some abstract theory. It has a real, powerful, direct effect on your mortgage payment, your car loan, and yes, even the price of your insurance. Let's look at how this feedback loop actually works. When rates go up, it does two main things at the same time. First, pretty obviously, it makes borrowing more expensive, which can reduce how much credit is out there. But second, and this is key, it allows those big insurance companies to earn a lot more money on the massive piles of cash they invest. That extra income then plays a huge role in how they price their policies. It's all connected. So now, let's zoom out. Let's put all three pieces, credit, insurance, and rates, together to see the full picture. This is how the big financial institutions actually look at the world. You have to understand, banks and insurance companies aren't worried about today's headlines. They're playing a much longer game. They're watching these slow-moving, fundamental signals. Things like default rates, how many people aren't paying back their loans, the overall growth of credit in the system. They analyze claims ratios, so how much they're paying out versus how much they're taking in. These are the vital signs of the economy's long-term health. So when you put it all together, this is what you get. This is the financial system stability layer. Credit is the engine. It's what makes growth possible. Insurance is the suspension. It's there to absorb the bumps and shocks along the way. And interest rates, that's the gas pedal and the brake. It's what regulates the speed of the entire machine. It's this beautiful, invisible structure that we don't notice until, of course, it comes under stress.
So as we wrap this up, the big question really becomes a personal one. When you look at your own finances, your own life, which piece of this invisible trinity do you feel the most? Is it the cost of getting a loan? Is it that insurance bill that keeps going up? Or is it the direct hit from changing interest rates? Just understanding how they all connect is the very first step to navigating the world they've built.